My name is Kwame Owino. I work at the Institute of Economic Affairs, and I welcome you to today's webinar. The Institute of Economic Affairs is a think tank, and part of our work is to carry out research on policy issues of relevance to Kenya, the region, and the globe, to subject those to public discussions such as this, and to generate insights which may be shared with policymakers, all with the aim of raising economic political freedoms, which together will raise prosperity for Kenyan people and for others. Now, we identified the Kenya's growth story over the last 30 years, and our view is that Kenya has a significant growth challenge. And that significant growth challenge is one of the big things that must be resolved through public policy. So among the things that we keep asking ourselves is, where will Kenya's growth come from? What are the lessons we can learn from the growth stories of other countries? But at the same time, to audit Kenya's own growth path since its independence, and to try and find out whether there are structural issues that need to be unlocked or addressed. Why? Because we are in agreement that regardless of whatever opinions Kenyans may carry, the idea that we need to re-energize or innovate Kenya's growth is confirmed not only by having an ambitious Vision 2030, which is now close to coming to an end, but at the same time that our common prosperity depends on growth first. And the third one is basically an empirical question, which has been determined that growth is a significant and important question for nation stability, for the prosperity of the people, its welfare, and of course, just generally for the effectiveness of government. So that's basically the reason here. So today, I have my colleague, Vivian Ochola, who's an assistant program officer in our popular economics program. And one of the things that she's going to lead us through is a form of a methodology that was developed by the World Bank, rather a classification method that was developed by the World Bank, slotting countries based on their income levels, which are proxies for welfare, and then telling us what the lessons are for Kenya to go along that continuum in a way that actually enhances Kenya's, in a way that is consistent with the national goals. So that's the first. And the second thing is basically to isolate Kenya against its peers. She'll justify why those are peers and to see what lessons we can draw, or what lessons can be drawn about the development models, if we may call them that other countries have. So my colleague Vivian is here. She'll speak for 25 minutes, and thereafter I'll open up to a question and answer session for all of us. So in the meantime, right on the toolbar right ahead, in front of you, there's a menu for chat and Q&A. Please use the chat box to ask any questions, which we will pack in, and as soon as Vivian is done, we'll allow for your questions to be answered. So once again, welcome, and Vivian, please go ahead. Thank you.
Okay, thank you very much, Kwame. I hope you can hear me clearly. So I'll head straight to the outline. So for the outline, we look at the background, some of the key indicators when it comes to classifying countries into national income groups. Then also, what is the world data, how the world has progressed over a different period of time. Then we compare Kenya with its peers. Then we look at some of the conclusions which will imply some of the policy recommendations for Kenya. So when it comes to the background, what we are able to see is that World Bank Group has been classifying countries by income level since 1987. That is around 39 years now. And it is updated every 1st of July every year, 1st of July every year. So at the end of a financial year. Then, so of course, it classifies countries into 4 broad income groups. That is, we have the low income, the lower middle income, then we have the upper middle income, then the high income. So all these classifications are based on gross national income per capita. So we'll be able to understand what that is. So it is important. This study is very important because it shows and also records the trend of progress of countries over time. So within the period of 39 years, we'll be able to see how have countries moved from different income levels, which countries have maintained their income level, which countries have moved backward, because a country can either move from low income to lower middle income, then from lower to upper. And also some country can be, because of shocks, because of crisis, will be able to note, can also move backward. So we'll be able to see what has been the trend over that period, how has countries moved. Then it also tells us, shows comparison, which countries or which continent is lagging behind while which continent is growing at a faster rate. So that is basically the background. So this analysis has been there since 1987 and it is done every 1st of July. Then we look at now the key indicator. The key indicator here, we see we have the gross national income. So gross national income is basically the total income earned by people and business, so by households and firms of a country, over whether the income is generated within the country, that is now GDP, and whether the income is generated outside. So GNI, which is gross national income, it incorporates both GDP and the income that is produced by firms that are outside the country. Then now, for the income classification, so we've seen the incomes are classified as either, the countries are classified as either having low income, low middle income, upper middle income, and high income. So what makes a low income different from a high income is the gross national income per capita. So we are able to see for July 2026, also this new financial year, so the low income countries, so these are countries whose GNI per capita is less or equal to 1,175 USD. So that is annual. So that is approximately about $3.2 a day, equal or less than $3.2 a day. Then when it comes to lower middle income, so this ranges between 1,176 all the way to 4,635. So countries with GNI per capita between 1,175 to 4,000, they are classified as low middle income. Then we have upper middle income. So for upper middle income, there are countries whose GNI per capita is between 4,636 all the way to 14,000. So we are able to note that it is a wider range, so between 4,000 to 14,000. Then for high income are all countries with their GNI per capita greater than 14,375. So it can vary to the highest income, maybe of 100 and something thousand USD. So if you look at that, so someone in a low income level per day, they're expected to have a GNA per capita, or their GNI per capita is $3.2. Then someone in the higher income is about $39.4 per year. That is for the lowest side, the 14,000. Then we are able to note that if you compare the classifications or the values between 2025 and 2026, we are seeing there's a change. So that transition is basically because of adjustment for inflation and for value for money. Then we are able to see now chart 2 tells us what has been happening, what has been the trend over that period of 39 years. So the chart on the left side, we are able to see number of countries based on their income group. So the scale tells us that when it is 20, when 20 or below, it indicates that lighter shade. Then for 90, where as it increases, the shade becomes darker. So if you look at that, if you look at the countries in low income over a period of time, the shade that has been fading. So that is the first row. It has been the color has been fading, and we are able to note that towards the end in 2025, there are less country in the low income level. Then when it comes to lower middle income, we are seeing it is not, most countries are still between here. It is not less and not higher at the same time. So then when it comes to upper middle income, we're able to see most countries in 1987, there were less or fewer countries in upper middle income, but as time progressed, the in 2020, from around 2011 to 2025, we're able to see that the number of countries in upper middle income is increasing. Then there's something also amazing when it comes to high income. Then for high income, there were a few countries in 1987, but it becomes darker in 2025. So it shows that there are countries that have moved, or the number of countries that are classified under high income have increased. So for us to get this clearly, it takes us to the table on the right. So this table, now we are able to classify, or we are able to get the data, real data for 3 different periods, an interval of about 20 years between. So we have 1987, 2005, and 2025. Then the classifications under low income, we have lower middle income, then upper middle income, and high income. So let us note, so for the first column, the first row, low income. What we are able to see in 1987, there were 49 countries, that is in total worldwide, that were classified under low income. Then the numbers in bracket, those are the countries that are in Africa. So we are able to see that in 1987, 49 countries worldwide were classified under low, of which 28 of them were from Africa, or were African countries. So 28 of 49 represent 57%. So 57% of low-income countries in 1987 were from Africa. Then, when we go to 2005, we are able to see that the number increased. So this tells us something, that countries can either move up or backward due to shocks. So we're able to see that the number of countries that were in low-income group increased by about 5, and 31 of them. So of these 5, Africa alone had 3. So from 28 to 31. So African countries increased by 3 countries that went back to low income in 2005. This was because of the shocks, like maybe the shock of HIV and AIDS. We are able to see some of the shocks the countries experience may make them go back to low income. Then when it comes to 2025, we are again seeing that there are 25 countries, so they have increased. So we are seeing that it has decreased from 49 to 25. So if you compare 1987 to 2025. So when it comes to lower middle income, the same trend, 45 in 1987, 10 are from Africa, then 57, it also increased, then decreased again. But there's something peculiar for the 2 income groups, the upper, middle, and the high income. So the first thing we are noting for the last 2 income group is that when you look at Africa, remember Africa is the one in red. So able to see almost at an interval of close to or more than 20 years, Kenya, or not Kenya, but Africa, only one country moves from either lower income, lower middle income to upper middle income. That's why we're able to see 1987, there were 3 countries. In 2005, there are 4 countries, so only one country moved. Then in 2025, another 1 country. But when it comes to high income, there's no country. Since 1987, there's no country in Africa that is classified as high income. And we'll be able to learn more about that. So for upper middle income and high middle income, there have been consistent growth. So many countries are shifting from a low income and lower income to upper middle income and high income. So if you compare, for example, the last column in 2025, we are able to see that in 2025, there were 25 countries in low income, 47 in lower middle, 59 in upper, then 85 in high income. Then now we want to see the picture, the image. So this chart 3.8 tells us that world data, so this was 1987. So in 1987, what we are able to see is that there were countries that were already high income, and that is North America, and the northwestern part, and also the southeastern part, that is Australia. Then when it comes to Africa, most countries in 1987 were low income, Kenya included. So at this point, I'll want us to note something, because we are going to single out Kenya together with its peers. So the reason why we call them its peers. So if you're able to note here, we're able to see Kenya is low income. Then the countries we are going to consider is Sri Lanka, which is also a low income in 1987. Then Vietnam is also low income in 1987, and also India. So at some point, all these countries were low income. So then we are able to see now in 2025, there's something that changes. If you look at the classification and how the income is distributed, or how countries are classified, the northern part of the world, you can say the northern part of the world is rich. They have high income. North America, we look at Asia, and some part of Europe. So if you look at the northern part of the world, it's rich. Then when we look at southeast, that is Australia, we are also able to see Australia is also a high income country. Then there are only 5 countries in South America that are not classified as upper middle income and high income. And these countries are, for example, we see here, we have Bolivia here, and Venezuela. So these are the countries that are still low middle income in South America. Then now let us come to Africa. We are also seeing that though there's some change, if you compare these and these, there's some changes in Africa, but Central Africa is still having a problem. Most countries in Central Africa are still low income, and Kenya has moved from low income. Since 1897, it was low. Then now it is under low middle income. Then let us look at the peers that we are comparing it with. India is also low middle income. Then when it comes to Sri Lanka, it has moved over that period of 39 years, it has moved to upper middle income. Then we have Vietnam as well as moved to upper middle income. And we'll be able to learn what has caused that movement over that period of time. Then for Africa, we are only able to see there are only 5 countries in 2025-2026 that are classified under upper. We have Algeria, Gabon, we have Botswana, and South Africa, and also so we have Algeria, Gabon, South Africa, and Botswana, and Libya. So, and we know that these countries on the north, they are resource rich. They have oil. That's why their income is high. Then we also have Botswana and South Africa. So only 5 countries in Africa are under upper middle income. The rest are low middle income and low income. Then now that brings us to a question: who moves and why? What makes a country to move? So from the 2025-2026 data, what we are able to see that there were 6 countries that moved from one income group to another. So the first country was Togo. Togo moved from low income to lower middle income. Then when it comes to these, we are able to see that 5 countries moved from lower middle income to upper middle income. And these 5 countries were Jordan, we have Micronesia, we have Philippines, Sri Lanka, and Vietnam. So we are able to see that Kenya's peers, the 2 peers, that is Sri Lanka and Vietnam, moved from lower middle income to upper middle income. So we'll be able to learn what caused this movement. Then we are also able to see there are countries in high income. But if you look at this data very well, we are able to see that towards the end, there are fewer countries towards the end. That tells us something very important. And another thing we are able to note here is that there's no country that moved from upper middle income to high income. So it is tough to move from GNI of 4,000 to maybe 14,376. It's a massive growth. It is an intense growth. So that's why it is very hard for countries to move from upper middle income and to high income. Then another reason is that to get there, to get from to higher income, it requires capital intensive production and growth. Or there are few countries in the extreme end. Then we're also able to know that it is also very difficult, even if a country is growing slowly, when it has attained a high income, for it to come back to either low or lower middle income. It is very hard. So a country with this high income, when growth declines, it cannot, except if there's a very bad shock and a very bad crisis. But it is difficult for a country to have attained high income to come back. And we have noted that North America in 1987, they were high income. And again, in 2025, they are still high income countries. Now let us go to Kenya and its peer. We've seen the world overview, which countries have moved, and also how is it distributed. Now let us go to Kenya and its peers. What are some of the things we can learn? So we went to dig deep into these economies to understand what are they doing that Kenya can learn from. So we are first looking at the population. Then here for population, we are able to note, so we have the different bars for different countries. So we have India having the highest population, then Sri Lanka, the lowest. Then we also see Vietnam, that is relatively twice Kenya's. Then we have Kenya. So if you look at that, what we are able to see here is that we've taken a sample. We've seen a country with highest population and a country with low population than Kenya, and a country that is almost close to Kenya, so that we'll be able to compare what is happening and what has led to growth and stagnation of other countries as well. So when you look at GDP, or the revenue as a percentage of GDP, when you look at revenue as a percentage of GDP, so in this figure or in this chart, we are able to see how countries' revenue as a percentage of GDP has been the trend between 2012 and 2024. So what we are able to note here is that all these countries, their revenues have been fluctuating a bit, not as much, and Sri Lanka has the lowest collection when it comes to revenue as a percentage of GDP. Then it has been varying. For all the countries, the percentage of government revenue to GDP is between around 10% and 20%. For India, it was somewhere highest 21 in 2021. So it has been varying between 10 and 21%. Then we are able to see that due to COVID-19, at least revenue shrunk for some countries, for all the countries, but not to a same extent. Some were affected. For example, for Sri Lanka, it was affected, and we are able to see that shrinkage between 2019 and 2020. And also they had an economic shock that led to shortage of revenue in 2022, but is showing some recovery. So we're able to see when it comes to revenue, the red line, this is Kenya. So we mark where Kenya is. When it comes to revenue, it is number 3 in terms of collections. And they tied in 2024, they tied with Vietnam. So revenue, we're able to see that we are not lagging behind. Then we go to expenditure. When it comes to expenditure, all these 4 countries, they spend between 16% and about 27%, with India had the highest in 2020 of about 30%. So it is between 16 and 30%. Then India spends more than all these countries. Then Sri Lanka spends less, except for 2020, where its expenditure surpassed Vietnam's. Then for the expenditure in 2024, Vietnam and Sri Lanka ties, but Kenya comes in between. So it is basically, it spends the average of the 4 countries. Then we have India at the top. So when it comes to expenditure, Kenya is number 2. Now let us go to gross debt as a percentage of GDP. So debt is basically the difference between expenditure and revenue. So most all of these countries spend more than the revenue. So to cover that, they borrow. So they have debt. So their debt as a percentage of GDP, we are able to see that in 2012, they tied 2 countries, that is Kenya and Vietnam tied. They had close to 39%. Then Sri Lanka and India also tied. But there have been a shift where Sri Lanka's debt has been growing, fluctuating, but the trend is upward. And from 2022, the trend started to go down. For India, it is the second one. The trend has been up, but from between 2021 and 2024, it is kind of constant. Then for Kenya, the trend is going up, except for 2023, because of fiscal consolidation, it started to decline. Then for Vietnam, we are seeing that a declining trend, and up to 2024, Vietnam has the lowest debt as a percentage of GDP, then followed by Kenya. Kenya's debt is not as high as Sri Lanka's and Indians, so it's the second lowest. Then it brings us to GDP. GDP, now the goods produced within, the value of goods and services produced within the country. So India, we saw that India's population is massive. It is the country with the highest population in the world. So that results to it having the high GDP. So India's GDP is highest as compared to all the 3 countries. Then followed by Vietnam, it is close to 500 in 2025. And it has been rising. So if you're able to see the trend for Vietnam, it has been rising. Also for India. Then Kenya and Sri Lanka, they almost tie. We are able to see over the period of time, but it's not growing as much. And we are able to conclude that Kenya, from this chart, it's able to show us that Kenya has a growth problem. It is lagging behind when it comes to growth. We can tell that here as well. So this is GDP per capita growth. Now this is per capita growth percentage annual. So we are able to see for all the countries, their GDP per capita has been fluctuating. And all these countries, one of the things that is evident here, that they are vulnerable to shock. And we are able to see that when there was COVID in 2020, every country except for Sri Lanka didn't shrink to negative, but we are seeing it shrunk. Then for all the other countries, they also shrank to negative, a growth. And we're able to see something with Kenya. If you look at Kenya, it did not shrink as much as India and Sri Lanka. Then it grew. In 2021, it was the second after India. Then we are able to see it bounced back, and it is now the lowest in 2025. Then we are seeing something for Sri Lanka. They had a shock, the global shock in 2020. Then they also had an economic crisis in 2022. We'll be able to see what happened and how they bounced back from 2022 at a growth rate of close to -8, all the way to a growth rate of 5.8%. We'll see what happened. So they surpassed Kenya somewhere in 2024, and now Kenya has remained behind. So we are also able to note from this that Kenya's problem is a growth problem. Chart 11 tells us the gross national income. Remember, this is what is now taken, or that is used to measure the income levels. So for growth national income, India still leads because of its massive population and its technological advancement and productivity. Then we have Vietnam, also low but above Kenya and Sri Lanka. It has also been increasing over time. Then for Kenya and Sri Lanka, if you look at the charts, the lines, they are almost close. They are close to one another. And if you consider it, it is not showing a positive growth trend. It is almost constant over the period of years. It has grown with a very, very small percentage, a very small percentage. If you compare 2011 and 2024, it has grown with a very small change that cannot be notable. Then when it comes to now GNI per capita, so we are seeing Sri Lanka is ahead. So this can be attributed to the fact that it has a small population, but it is so much ahead as compared to all the 4 countries, then followed by Vietnam. So when we look at if we want to claim that maybe Sri Lanka is high because of population, but for Vietnam, their population is more than twice ours, but it is still high. So it means that Kenya, in as much as population is growing, the growth of GDP per capita, or GNI, the growth in the economy is not matching the population growth. That's why we are still lagging behind. So India as well, it's the third line because of the massive population. So it tends to shrink the GNI. Then it is almost close with Kenya's. In 2020, they were the same, but India grew and surpassed Kenya, while Kenya's shrunk a bit, and it is between 2024 and 2025, it is almost constant. So we are able to see from this chart as well that Kenya's GNI per capita is the lowest. Then let us look at Sri Lanka and Vietnam. So Sri Lanka was high. It sustained the growth until somewhere in 2022 when the economy collapsed. That is when Vietnam surpassed and it went a bit low, but after recovery, it has been increasing as well. Then there's something very amazing with Vietnam. Its growth has been sustainable. It has been steady. Even during COVID, it wasn't affected. It has been steady from 2011 all the way to 2025. So it has been experiencing a steady growth. Now, because our main focus was these Kenya's peers, there's something important, an important lesson to learn from Sri Lanka and Vietnam. So we're going to see what happened to the economy, what is their secret, so that Kenya can know what the problem is. So when it comes to Sri Lanka stories, three years ago, that is around 2020, 2023, 2022, 2023, there was severe economic crisis. The country experienced severe economic crisis to an extent that they exhausted their foreign reserves. So this information is in the IMF data. Then they defaulted a $51 billion debt, that is in April 2022. So they had a severe economic crisis. Then today, they have recovered. And what led to their recovery if you read that information, it says that physical discipline combined with external support help them to recover and to sustain that growth of a growth rate of 5%. So it was driven by a rebound across industries, growth in financial and tourism, and also physical discipline and support, external support. So we're able to see that Sri Lanka came from a worst state to a better state. For 2025-2026, the World Bank had predicted its growth to be at 3.5%, but they surpassed to 5.8%, and that made them move from lower middle income to upper middle income. So they have been showing a consistent growth. Then the story or the case for Vietnam. So we're able to see the case for Vietnam. It is a story of growth powered by export-led model, export orientation. So we are able to see that between 2024 and 2025, the country's export, that annual growth was 15%. That's quite massive. Then GDP grew by about, between 2024 and 2025, it grew by 7% in 2024 and 8% in 2025. So it experienced much economic growth, while we've also seen that its population did not grow as much. Then it also tells us that Vietnam's export to GDP elasticity indicates a stronger relationship between export and growth. So we are able to see there's a stronger relationship between exports and growth. And we are also able to see the gross national income expanded at an average of 10%. That was annual. It was a sustained growth between 2021 and 2025. So these are a chart to show that when we are talking about exports, it's not a lie. It's true that, and this is data from World Bank, it shows that exports, Vietnam's export has been very, very massive. It surpasses all the three economies. So it has been growing steadily. It is the export to GDP, exports of goods and services as a percentage of GDP is close to 100 in 2025. Then when you look at Kenya, for example, it's lagging behind when it comes to exports, less than 20% of GDP, and it is not showing an increasing trend. Then for Sri Lanka, it was a bit higher than India, but India surpassed, but they are still lower than between 0 to 20%. Then now that brings me to the conclusions. So what we are concluding in all that information is that growth is important. Growth is important. Then another thing is that physical sustainability is a prerequisite for sustained development. So we were able to see something that happened with Sri Lanka here, is that if growth is not sustained, if physical sustainability or if physical consolidation or physical is not sustained, it can lead to a deterioration. So it is important to learn that physical sustainability is important, or it comes first for a sustained development. So if you want to sustain development, there must be a physical sustainability. Then income classification is an outcome. So it is not a development strategy. So because maybe, for example, Kenya is a low middle income, that does not mean that it is basically an outcome of what we have diagnosed, that our growth is a problem. It is not a development strategy. Then we've seen that Kenya's biggest challenge is growth. Now, 3 lessons Kenya can learn from its peers. The first one is to adopt an external orientation value addition strategy. So Kenya should expand its markets abroad. And we've seen how this has helped Vietnam to grow massively. Then when it comes to exportation, there should be valuable goods, value addition strategy, not any other products. Then Kenya should also build a fiscal discipline. Fiscal discipline is important. This is what helps Sri Lanka to bounce back. Then protect productive spending. Then lastly is to invest in human capital and productivity. You know, when our population is growing faster than growth, there's a problem. So a country should be able to invest in human capital so that as population grows, it translates into growth in GDP. And that's all. I'll invite Kwame to tell us more. Thank you.
All right, thanks, Vivian. So let me try and summarize what Vivian did. The question we are asking ourselves in this webinar is, what lessons, or rather, what does the World Bank's publication every year on the 1st of July, classifying countries by income groups, the categories, tell us? And I think Vivian has told us that it tells us two things. That over the last 40 years, from 1987, when this thing was first published, when this publication first came out, we have seen human progress in terms of income per capita over time. That's an essential thing. There have been instances as well in which, especially in the middle part in 2005, when for some countries, especially at the lowest income level, actually regressed. But over that next 20 years, there's been progress. So fewer and fewer countries are left in the band of low-income countries. So that's the first. The second point is that if you take a geographical or spatial approach to it, you can tell that at the end of 2025, when the last snapshot was taken, and take the snapshot in 1987, which is about 37 years, not only have fewer countries grown away from low income towards middle income, but a majority of the countries that are now lower income are predominantly African countries. So that's basically what this story tells you. And then secondly, that spatially, the world is also divided by income groups. So if you go to northern countries, they fall within the upper income levels. Now that upper income level is also itself very vast. And it puts together all countries at 14,000 levels. So you have countries there such as Russia at about 14, 15, 16,000. And all the way back to countries such as Singapore. I had to mention Singapore at almost 10 times that. But basically what it's telling you is that you can divide countries into that spectrum. And if you use income and income per person, which is their consumption that would be available for every person and the value produced in that year for every country, it's been rising regardless of population, because you've corrected that for the population. Then we come to the lessons asking us that, okay, which are the latest countries that have moved from Kenya's position classified as a lower middle income country into upper middle income? And we saw that there are 5 countries. Of those 5 countries, with the exception of Jordan and Micronesia, the other 3 are countries that we at the Institute of Economic Affairs consider as Kenya's peers. Now, Vivian did not explain this. Why are they Kenya's peers? They are Kenya's peers because when Kenya started the reform program in the 80s, at the time when this measurement or categorization by the World Bank started, all those countries were at Kenya's income level. Actually, Kenya was a little higher than most of them. Kenya had a higher income than India, had a higher income than Cambodia, and obviously by Vietnam, which are countries that have undergone serious war. And Sri Lanka was also around about that area, even though it's so. Vivian then slices the countries by population and tells us that population doesn't matter, though of course the charts exaggerate India's GDP because of the overall population size. It shows us that Sri Lanka for a long time was the leader among these 4 peers, Kenya's peers. It's at a sustained growth rate. So the lesson is not just to get a high growth rate, but to sustain that growth rate over and above. I think it was a slip on Vivian, but I don't think she meant that the population growth rates in Kenya are higher than income growth rates. He simply says that if you're growing at 4% and half of that is adjusted for population on a per capita basis, then the effective growth rate for Kenya is just 2. While it is about 5 for Sri Lanka, it's 8 it's 6 for India, and it's 8 for Vietnam. And you see that sustained growth over time. The third point that Vivian made is that countries suffer from certain shocks. And you can see that some shocks are induced by domestic policy, such as Sri Lanka's after 2021-22. Other shocks are global. But growth is an important one because you can see that the countries that had a higher path to growth were the ones that are able to. We are talking Vietnam, Sri Lanka as well. Of course, India to a little extent, Kenya also did. So while Kenya's dip was lower in 2020 because of the pandemic, its recovery was basically to the levels before, and therefore the other countries once again are. And then the final one, which is significant, I think the thing we need to explain, it confirms the case for us that Kenya is not lacking ambition, but structurally Kenya is a laggard in growth. The growth rates that Kenya has do not match ambitions and are not creating the structural transformation that countries such as Vietnam have shown. And of course, the final one is basically the external orientation. You ask yourself, when a country has exports equivalent to 80% of GDP, it means, and exports are growing at 15% year on year, that is what sustains an 8% growth rate in Vietnam's case. That is telling. That's not Kenya's case. If Kenya had an export level equivalent to 80% of GDP, it means that Kenya would be exporting $96 billion worth of goods, which is 8 billion per month. Now, that's a big step. Not impossible to achieve, but it would require a completely different orientation to industry, a completely different orientation to government expenditure and government's surpluses. Bear in mind that when we checked, Vivian and I, Vietnam is not spending more money on infrastructure as a share of national income than Kenya. So the idea cannot be an infrastructure constraint. It might have to be, as Vivian said, responsible fiscal policies. It's not just about how much government spends, because when you saw the ranking of all spending, Kenya is actually not last. It's last in growth, last in exports, but it's not last. It's last in income, but it's not last in government size. So again, it's telling us up there that government size is not it. There's a structural thing that affects growth that Kenya needs to fix. And part of that might be an attribute that gives it an external orientation. So basically, that's my short summary. I'd like to open this up for conversations. Now, I see already there's a question here from, is it Kenneth? Kenneth Watcher? And Kenneth is asking, Vivian, what is the reason behind your conclusion that a country that has attained high income cannot slide back to middle or high income? So Vivian, maybe you can answer that, unless Ken wants to speak on it specifically. Ladies and gentlemen, I'll open up this conversation as well to any questions. If you wish to, please raise your hand. You'll be unmuted and you'll have an opportunity to ask your question. Do we have any questions? No, I don't see questions now. So Vivian, please respond to Kenneth's question on the chat box.
Okay, thank you very much. So just to be clear, I didn't say it cannot, but it is difficult. It is very difficult for a country to slide back. So this is because once a country reaches high status or high income status, it is generally difficult for it to fall back. So this is because of its structural changes that makes the economy more resilient. So it can fall back if there's extreme economic shock and also decline in growth and things like wars that can really affect the economy. But it is difficult, though it is not cast on stone that a country cannot go back. Yeah.
Yeah, thanks. Yes, so Vivian's answer is basically it's difficult for that regression to occur. And part of the reason is that an institutional cultures already exists, and the economy is resilient, economic management has to be decent to get to those high income levels. And therefore, you can respond to shocks as well. And you have institutions and structures and industry that is very capable, including its suggestion, of course, of your human capital. So I think that's a good answer in the sense that it's very, very difficult to actually reverse gains. What an economy can produce at high levels, because income per capita, GDP per capita, and a high GDP per capita suggests very effective industrial management on that. And that shows it's a private sector thing that's been enabled if government does enable private sector. So it's really, really difficult to ban all that even if a shock occurs, because as you saw, when a shock occurs, the resilience is such that yes, these economies are able to recover. So I think that's a good answer. Kenneth has another question, Vivian, so you're not off the hook yet. He says, on Sri Lanka's success story, what did they do that attracted external support that Kenya can learn from and emulate? Vivian, once again, your question.
Okay, thank you. So the main two things that I learned from their success story is that what they did was fiscal discipline. Sri Lanka went into fiscal discipline that attracted external support and also governance reforms. So remember, what makes a country vulnerable also to shocks is when there's poor governance and poor policies. So Sri Lanka went into governance reforms and policy reforms and also a fiscal discipline that attracted support from external. So those are the main things that Kenya can learn: fiscal discipline and governance reforms.
All right. Any other questions? I haven't seen any other questions, and I hope I haven't forgotten them. Yes. Oh, Kenneth, okay. Fine. So any other questions? We have Kenneth, I hope that answers your question, but I have one more question for Vivian. Now, Vivian, as the idea, we've been laboring with the question about how do we get Kenya's growth? And we are sure that while Kenya grows at 4.7%, just shy of 5, and this year, obviously, the growth target was revised downwards from 5.1 because of the drought, because of course, the global effects of the conflict in the Persian Gulf, I think, which is continuing and which has gone on for much longer than anybody anticipated. So Kenya's growth forecast by the IMF as well. I'm not too sure. I haven't looked at the central bank, but I think the central bank was also cautious in the last monetary policy release. So it's going to be less than 4. So it's going to maintain at 4%, which means that's a long-term growth trend that Kenya has. Now, Vivian, you remember last week at a presidential event, the governor of Kisumu, Professor Nyong'o, and a team issued a paper or a framework calling for governments to establish a new long-term vision. And do you have any views of that? And what do you think are some of the lessons that we could carry from this to try and inform, if not that process, but conversations about what kind of growth model, so to speak, Kenya should pursue?
Okay, thank you very much. So some of the growth models Kenya should take or perceive to grow or to attain a sustainable growth. One, we've learned from Vietnam, export-oriented or external orientation. Kenya should open its borders and also go out there and exports of goods and services. So there's a statement we said earlier that in Kenya, there was a policy that says that build Kenya, buy Kenya. But I don't think that works for Vietnam as well. I don't think if they have a policy of buy Vietnam, build Vietnam. We have seen Vietnam is growing massively by allowing by exporting its products to outer economies. So one of the things that Kenya should consider, and based on a certain blog that I wrote, is that they should remove or minimize restrictions when it comes to trade so that it can be a free economy to allow for trade or to allow for exportation to different countries. So as it's expand or enlarge its market, it will also help, because we have seen there's an elasticity when it comes to exportation and GDP. So one of the comments that I will give is that Kenya should consider more when it comes to exportations of goods and services. Then also physical discipline is very important, and as well as policy reforms that aid growth. And when speaking about physical discipline, the country or the economy should stop wasting resources or stop wasting money on developments that do not have a positive return and focus much on building human capital. because we are a growing population, and close to more than 70% of Kenya's population are young people. And when the country focuses on building human capital, it will raise productivity and thereby increasing growth. So that is what I can say.
Right. Okay. Thanks. I don't see any. Oh, there's another question here. When you say external support, for example, the Sri Lanka case, do you mean lending from the IMF or FDI? Just wanted to clarify on that. So that's Farah. I don't know whether you're asking Kenneth or asking we at the Institute of Economic Affairs. But since Vivian answered that question, Vivian, what's your view? When you say external support, though that's not your word, that was the word by that was mentioned by Kenneth in his first question. So please respond to this question. Is that external support FDI or is it IMF? Yeah.
Yeah, so from what I got, when it comes to external support, it is lending, like when an economy is in a deep crisis. So the external, like IMF, when they come in to lend money also to support the economy, or also even to extend grace period when a country has high debt. Like for Sri Lanka, we've seen that in 2022, they defaulted on a 51 billion debt. So external support here can be extending the period for paying the debt and also lending when in case of a crisis.
Right. Okay. Thanks. I think Vivian is mentioning it's not either or. Basically, if you have a country such as Sri Lanka, which had a financial crisis, government defaulted, then obviously an IMF program helps to stabilize the economy, reduce inflation and all that. And that's a signal as well, because FDI would not come in for a struggle economy. So it's not one or the other. It's basically a combination of policies that allows for confidence in the economy and its management to grow. Now, I see no other question. And so since all of you you don't have a question, I'll ask Vivian to make any concluding remarks before we can close the meeting. Vivian.
Okay, thank you. So I'll conclude by first saying thank you to everyone, then also to say that it is true countries do move and from one income group to another, and there's also a possibility of going backward and a possibility of stagnating. Some countries can be in one income level for a long time. But the lessons we have learned from Kenya and its peers, we can also, as well as our peers, grow to an extent that we move from low income, middle income to upper middle income. And that growth is to be sustained. It is not a growth like, for example, maybe Kenya, if 1 year we grow at 8% and the following year we go back to 3%. So when it comes to growth, we must come up with policies that helps in sustained growth over a long period of time that will be able to classify us as a growing economy and can be able to shift us from low middle income to upper middle income. So there are lessons for us. We've seen the lessons that Kenya can learn, and it is important to learn from our peers so that we may be able to grow even as our population grows and even as our economy grows. So thank you.
Okay, thanks a lot, Vivian. There's just a question here or rather a comment from Kenneth. Since it's a comment, I think I should read it out. So Kenneth says that this is a general comment. The IEA Kenya webinar addresses a crucial policy issue: how Kenya's shift to lower middle income status has altered its access to concessional debt and exposed it to higher borrowing costs. Yet relying solely on the World Bank's GNI per capita framework risks oversimplifying the country's economic health. Because GNI averages masks severe income inequality, ignores climate vulnerability, and fails to reflect the household level deprivation. Future webinars would benefit from contrasting the World Bank model with alternative measures like the UNDP's Human Development Index, the Multi-Dimensional Poverty Index, and the UN's Economic Vulnerability, to provide a far more comprehensive picture of Kenya's true structural transformation and financial resilience. Now, Kenneth, we accept your point, and I think we received that quite a lot. Remember, we did not say we are explaining inequality. And none of us said that Vietnam is unequal and we are explaining Kenya's growth problem. So keep us at the fact that we keep on the topic that we're saying. So you're saying that perhaps we should describe inequality as well. Maybe that's the question for another time. But basically, to describe growth and income per capita is complete in itself. How internal distribution takes place is a different question altogether. Important, yes, but we keep ourselves to the conversation that we wanted to have today. So that's a part. The second point that many people miss, I hope you're not missing it, Kenneth, because I think this is this is critical for somebody who's discussing human welfare and growth over years to understand. The Human Development Index, when you cross-reference the correlate the Human Development Index and income, right? It has an R squared of almost 0.8, meaning that 70% of, close to 70% of the differences, or rather that the Human Development Index correlates up to 70% of it is explained by income change. That's very high elasticity. So when you're talking about Human Development Index or HDI, I mean, an income, you're probably measuring 70% of the same thing. So I think you say context is important, and to understand the nuances and complexity, please take that at home as well, because you're right. But at the same time, you're measuring income can be a big proxy for Human Development Index. Why? Because the Human Development Index is three things. One, it's education attainment. Two, it's health. And three, it's gender and human education, health, and gender life expectancy, and human, and gender disparities, right? Women's empowerment, women's accomplishments for women welfare. So I think it would be a good debate in a graduate class. But if you're economists, we know we are talking about the same thing. So I agree with you. I mean, I understand your interest and your specific focus in HDI, but you're basically measuring this. Let's come to the environment. Environmental Vulnerability Index, using obviously the same using the same methodology, also highly correlates with income growth. So that's why we say income is a big explainer of most of human welfare. It is a big explainer of most of human welfare. And it correlates very highly in such a way that there's high elasticity, and income is both sufficient, empirically sufficient, and empirically necessary to advance human development. And so I understand the nuances that you're asking us to be alive to, but at the same time, it is not as if we are wishing them away by looking at income growth and human development growth. And your beef with the World Bank's GNI is, again, I think a quack, to be honest. It doesn't matter. The only reason we use the World Bank's GNI is because it allows for comparability about questions. And when you look at the World Bank's GNI again and Kenya's measurements, which comes from the National Bureau of Statistics and the Central Bank, which is what the World Bank appropriates and calculates, it's the same thing. So I have no beef with using Central Bank, IMF, and World Bank and all that. They tend to be the same source, which is a national source. So once again, thanks for those comments. So let me close down the meeting with two things. One, Kenya has a growth problem. Whether you measure it in whichever way, Kenya has an economic growth problem. It's growing far too slowly to create structural changes. That's a given, and Vivian has told us that. It is not impossible to grow, and Kenya has certain peers which we have chosen, and those peers tell us that there are certain things that one needs to do. An external orientation which allows for countries to do. India is growing fast. It's a big economy as well. But the country that can be emulated both based on Kenya's population and recent history is Vietnam, which has done a 15% in the last 1 year alone, year-on-year growth on exports. So an external orientation is a useful way to, it seems like one good way for that policy. But the policy choices that a country makes impact the welfare of its citizens through the growth channel. And I think that's also useful here for us to bear in mind. So choices have consequences. I'm sorry to mention that it's a common refrain in Kenya's political discourse, but I think it's also a consequence here. Consequences that affect growth, affect people's welfare, and affect income as we see it. So I think at the same time, Kenyans are correctly concerned about what could be a method to generate faster growth for Kenya. But the point that we have learned is that fast growth by itself is not enough. To be able to have sustained growth, sustained, not sustainable, sustained growth, which means lock in a high moderately high growth rate and sustain that for a long time. As you can see, Vietnam's case for over 12 years, it has enormous implications for the lives of people. And because people are the ones that matter the most, anything that grows people's lives and enhances their welfare is of significant importance to the Institute of Economic Affairs. Ladies and gentlemen, we are thankful to you for being here. This was our 31st webinar. The Institute of Economic Affairs is an organization. If you're a member, please send us an email and we'll give you the a brochure explaining what the process is. Very simple process, together with the benefits of membership. But more importantly, we are very grateful for all of you who've taken the time to be here today, to listen and to give us your thoughts. If you have any other thoughts based on your watching of this, please send it out to us and we'll be glad to respond to you. Finally, if you have topical questions affecting Kenya's economy, the region, or the world that you think of significance and that the IEA should host a conversation on, even if you yourself wish to be one of the panelists, please let us know. We'd be glad to have these conversations going. One of the biggest things that we wish to do through this is to expand public education and an understanding of common economic concepts and how they affect Kenyan lives and how they apply to Kenya's situation and regionally. So I thank you once again, ladies and gentlemen. Thank you for being here. And I'd like us all to clap for Vivian, who's made a fantastic presentation to us. Vivian, thank you very much for the preparation that you put to this. And my colleagues at the Institute of Economic Affairs who together made the communications with you. Some of you had a problem with the logging in. I think we're going to still fix that. It's a process. It sometimes happens one way or the other. But we hope that in the next time we'll be able to have you all register, log in time so that we can have these conversations with you appropriately. Thank you very much and have a good morning.